Hey everybody, welcome to week 3. Um, Starting out here, I just want to kind of do a overview like I did last week for what's expected here in week 3. Starting out here on the homework grid, if you notice here, we're on the third week. We're going to be covering chapters 5 and 6. Two assignments, just like last week, two homework tasks as well. This week, instead of a quiz, we're taking a midterm. It's going to be a longer um, test. It's worth a bit more. It's going to cover everything that you've learned in weeks 1, 2, and 3 as well. If you notice here, we, well, at least according to the college, 25 hours is expected of for you to do the readings, the assignments, the homework, discussion questions, and the midterm as well. So 25 hours, that's more than what they've allotted for the previous weeks and is probably the most for the course. So here I am in assignment number 1. It's very similar to assignment 1 for weeks 1 and 2 as well. If I can scroll down here, you'll see you're doing a general journal, a ledger, trial balance, uh, some other schedules, including income statement for these transactions that transpired during the month from the publisher here, and these transactions mostly are pertinent to this week's readings and um, lessons. So you'll want to pay particular attention to the readings this week. Okay, I'm in chapter 5 now here in the textbook. Chapter 5 is pertaining to accounting for merchandisers, meaning retailers and such. Um, Here, really early in the chapter, they come to a big concept I want you guys to all be familiar with. It's the idea of the fact that the cost of goods sold is subtracted from basically total revenue to equal gross profit, and then you minus your other operating expenses to come to net income. That's going to be something we touch on in our one of the discussion questions this week. So pay particular attention to that, if you will. Here on page 194, they kind of start walking you through the initial purchase of inventory by the retailer, and further down here, if I can scroll down. Hold on, I'm gonna have to pause for a second. We get into the the concept of purchase discounts. Purchase discounts are basically a discount that the retailer will receive based on whatever the credit terms of the purchase agreement with the wholesaler provide. Typically, if you pay within 10 days, there could be a 10% or a it depends, of course, but there's a percentage discount if you pay within 10 days, and then the net is due within 30 days. So that in 10 slash EOM would mean 10 days within the end of the month. Now, conversely, this 2 slash 10 comma in slash 60 would mean 2% off if paid within 10 days, and the net is due within 60 days. So uh, these this little code that they explain here on 195 is going to be very important, and will help you decipher sort of the credit terms that a wholesaler and a retailer will come to an agreement upon. Some more big concepts I want you guys to pay attention to here in the chapter are transportation costs and when ownership transfers. Um, so I'm not sure which page. Here on 197, we get into the concept of accounting for transportation costs and the concept of when ownership transfers on merchandise that's bought from a wholesaler. And I want you to pay particular attention to this part of the chapter. There certainly will be questions on this, I would imagine, on the midterm. But basically, this sort of breaks down when ownership changes on goods in transit and who pays for this for the shipping costs when a retailer buys merchandise from a wholesaler. And pay attention to these terms here. FOB shipping point is when the buyer owns the merchandise. Ownership actually transfers when it leaves the seller's building. And the other term is FOB destination, which is um, the seller owns the merchandise until it reaches the buyer's warehouse. And in these situations, it's whoever owns the merchandise is also paying for the shipping. So FOB shipping point is going to generally point towards the buyer paying for the shipping costs. And FOB destination is going to point towards the seller paying for the shipping costs. And just one thing I do want to mention here is FOB stands for free on board, just in case you were wondering. Okay, getting into P2, starting here on page 199, we get into the actual merchandiser selling their merchandise. So here right off the bat, they give you kind of a thumbnail sketch of um, at least the top side of an income statement. This is important because it distinguishes itself. It's certainly different from in most other kinds of businesses uh, due to a couple things. First, the sales discounts that they may issue would be deducted from sales, and also the sales returns and allowances to get you to net sales. And then there's a cost of goods sold to get you to gross profit. Gross profit is going to be different, like I said, from net um, net profit because the net is actually going to be after all other operating expenses are deducted. So be sure to note that difference. And here they sort of break down the um, sales of merchandise. Basically, each sale is going to include these two parts: revenues received in the form of an asset from the customer, and the cost of goods sold incurred for the merchandise sold to the customer is going to be deducted from that to reach a net profit, or rather a gross profit, I'm sorry. Starting here on page 200, we get to some of the other concepts that I touched on a second ago, including the sales discounts, sales returns and allowances. That's the retailer taking back merchandise. Wrapping up chapter 5, starting on page 202 here, they touch on how to complete the accounting cycle for a merchandiser. So I want you to pay attention to exhibit 5.10 there, the adjusting entries for merchandisers rather. So read these paragraphs. Um, then we get into closing entries, and they give you a great example of basically all the entries you'll need to know. Here on page 205, we get into the multi-step income statements. Differ from what you've seen so far because it's sort of split between uh, everything it takes from sales to get to gross profit, which, as I mentioned before, sales discounts, sales returns, and then the cost of goods sold get you to gross profit. And then from there, it's all your operating expenses, be it depreciation, rent, store supplies, insurance, that type of thing, to get you all the way down to net income here on the bottom line. Conversely, a little ways down, they give you a single step, which is what we've seen so far up to this point. It's just revenues and then minus expenses get you to net income. All right, jumping ahead now, I'm in chapter 6. Chapter 6 is inventories and cost of sales, which is a great kind of extension from chapter 5, dealing with the merchandising accounting. There's some concepts I want you to see right off the bat here, the first parts of chapter 6, including goods in transit, goods on consignment, and damaged or obsolete goods as well. Okay, on page 241 and then going into page 242 there, there's the concept of perpetual income and perpetual inventory systems, and then I'm all mixed up here. Perpetual inventory systems and periodic inventory systems. So you want to be familiar with both of these concepts. Most large retailers, actually all large retailers, are going to use a perpetual system, and only a small business would even think of using a periodic system. But I want you to be familiar with these concepts as you move through chapter 6. All right, moving down further here, we get into some more concepts I want you to be familiar with. First, starting off with the first in, first out concept. And basically what we're getting at here is the flow of merchandise that the retailer's selling. First in, first out would be um, basically as it sounds. The first merchandise that you receive in will be the first merchandise that you sell out. Moving down, um, we get into last in, first out, which is the exact opposite of FIFO. First in, first out, up above here, sorry, is typically called FIFO, and last in, first out is typically called LIFO. I'm sorry, LIFO, which is again, the concept is basically the last merchandise that you received would be the first that you'd sell. So be be thinking about examples, physical examples of both, as you begin to read through these. Further on down here, we get into a weighted average. It's basically the average of both LIFO or FIFO. So make sure that you understand all three of these concepts as we move through the chapter. Okay, here at A1, we sort of get into the the meat and potatoes of LIFO, FIFO, and average cost. Each one of these systems will have a different effect on income. So be sure to look at this chart here and sort of at least try to grasp how each one affects the income of a business, because it's not only just the physical side of it, it's the it's the income side of it as well. So I'm going to stop rambling on here and let you guys get to it. Naturally, if you have any questions as the week progresses, be sure to reach out to me, especially on the assignment or the midterm. I'm going to try to have a solid example for you guys to work off of on the assignment, probably mid to late next week, so or later in week 3, I should say. So good luck. Keep me posted if you have any issues, and I'll just see you in class. Thanks so much.